Okay, so let's see the syllabus for the FRM Part 1 program. So it's been divided into four main books. The first is Foundation, second is Quants, third is Financial Markets and Products, and fifth one is Valuation Methodology. So in total, they have about 60 readings combined, and each one is as important as the other. But we have 100 questions in the exam, and the weightages given by the institute are 20, 20, 30, and 30 to these, which means 20 questions, 20 questions, 30 questions, 30 questions, and they'll not be ordered, they'll be jumbled up, and some questions might require concepts from more than one reading together. So you need to pay attention through every reading, through the videos, and through your own self study as well. Self study is really important in these professional exams, and I should give a disclaimer, so to say, that there will be a few questions between one to four, let's say, or five, or maybe more, could be more questions beyond the scope of the curriculum, beyond the scope of the prescribed curriculum of the FRM exam. And this is common in every professional exam, and there is no way to teach those teach for those one to four or prepare for those. The only preparation you can do is staying updated with current events, news, and trying to apply whatever you learn practically, reading more, learning more risk management methods, how firms actually employ these methods in reality, and everything is available on Google. You can find everything over there, and you should keep updating yourself regarding that. So, and again, one more thing, important thing. For example, let's say financial markets and products and valuation methodology. So the valuation of methodologies are of these financial products, and some concepts in valuation will be required from financial markets, but there are some concepts in the markets and products book which will be required from the valuation methodology. So they are very interconnected, and there is no set way I can say that you study this first and you study this first. Wherever you get stuck in one part, you just note it down somewhere, like keep a note part that I did not understand this part exactly, and you can either email me or you can wait until you complete the syllabus. After that, I think that part will be clear, because these things turn up very often. Even when I was studying, I had these issues. I will prescribe an order of study, but that won't be completely accurate, because there might be issues like the one I've mentioned right now. Now moving into the book-wise classification. So the first one is foundations, and as the name suggests, it establishes a foundation for risk management. That is, it introduces what is risk management, what are types of risk management, and then how is risk governed, the structure of the board that needs to be made for a efficient risk management process. And then it talks about the financial disasters in the past. Basically, it lays a framework and establishes a strong base for the students who are getting into risk management, who are getting into the FRM program for the first time. And these readings need to be done first. And the last reading, this one, reading 11, is about ethics. So ethics is pretty important. There are usually 1 to 3 questions from ethics, because people are really unethical nowadays, so to say. And most of the crises in the past have been because of unethical behavior, not because of some failure. It was because the managers were unethical, and they led to their own demise. And again, this reading is completely theoretical. So moving on to the second book, sorry, which is quants, and there'll be 20 questions, and it's, as the name suggests, quants. It is completely quantitative. So there are three parts to that. First is the basics of time value of money. So I'll be doing an introduction reading on time value of money. So intro to TVM, I'll be doing a introduction video on this, because it's really important you understand how time value of money works in this world. For example, $1 today and $1 after 1 year are not the same thing. They don't have the same value, obviously, because we understand, first of all, there is inflation. Second of all, there is risk premium. Uh, and if you're investing the money, then there are other considerations that need to be made as well. So we need to understand time value of money very thoroughly, very thoroughly, because it will be these concepts of quants might be used in other studies that you want to do, or that you have done in the past. Maybe if you're taking a CA or a CFA or any other studies that you've pursued, quants will be a very important part of those, and especially time value of money. So in quants, the second and third topics are probability and statistics, and only the basics of probability and statistics, the basic concepts that are required for you to be a successful risk manager are in there. And it's not very difficult once you understand everything. And there will be a few tricky terms and a few tips and tricks here and there, which I'll tell you. And there's no need to worry in quants as well. Even if you are not from a non-mathematical background, these are not questions like you'll have to take out the log of something, or you'll have to do some trigonometry or graphing or anything. These are very basic financial maths. You'll have one calculator like this. You'll have to take this calculator as prescribed by the Garp Institute. And there are a lot of calculator videos, and I'll talk about calculator later. It's very simple, the quants part, once you go through everything thoroughly. Third and fourth, financial markets and valuation, they are very interrelated. Financial markets and products, they introduce a lot of fixed income and derivative products. So fixed income products would be, for example, let's say a bond. The most basic fixed income product would be a bond or a loan. And you understand how they are fixed income because after every 6 months you will get a specified amount, and after the end of the contract, let's say whatever the maturity period of the bond is, let's say it's a 10-year bond, so after 10 years you get the face value of the bond, which is usually we consider $1,000. And derivatives part, I'll be introducing a number of derivatives to you as well. And derivatives have become a very important aspect of finance recently, and they help you to hedge your risks, and they help some firms to earn profits as well. And I'll be doing an introductory video on intro to derivatives as well. And in the valuation methodologies, again, as the name states, there'll be valuation methods for these fixed income and derivative products. And some of them are very important and some of them are in actual use. I mean, more advanced versions of them are in actual use by organizations today. And you can, after studying, maybe if you're really interested, you can open up Excel or any other software and try to implement some of these models. Like you get some data from somewhere, like if you get the S&P 500 returns monthly data for the last 10-20 years, you can easily get it. And maybe if you want to be more judicious, you can remove the parts. For example, March 2020, you can remove that data because that would be a huge outlier. And both these subjects, financial markets and valuations, will be 2/3 quantitative and about 1/3 theoretical. It's again a ballpark figure. It's not fixed. I'm talking about the more about the concepts and less about the exam questions over here when I say 2/3 and 1/3. And overall, it's a very introductory, so to say. It sets a base for you to move into FRM Part 2, wherein each and every risk type, so there are about 7 risk types. FRM Part 2 has 6 books. So first 5 are 5 risk types. That is market risk, credit risk, operational risk, liquidity risk, investment risk. And the last one is current affairs. So wherein all the recent current affairs are discussed. For example, when I was studying, the most recent current affairs were about fintech, big data, AI, and then one of the readings was on money laundering, financing of terrorism. Then one was on the risk of climate change on finance. It is evident, the climate change is so evident from this reading itself, because earlier the risk of climate change was a paragraph, then it was moved into a page, and now it is a complete reading. So climate change is so real, and we should work towards reducing the effects of climate change as far as possible, even in our daily lives, even at your homes. Reduce it as much as possible. So it'll be good for you and your future generations moving forward. That was a very basic introduction of the FRM Part 1 syllabus. So let me just show you a few of the modules names to begin with. Just a second. So like in book 1, the first one is building blocks of risk management, where they introduce what is risk, types of risk, blah, blah, blah. The second one is how do firms manage financial risk. So it's very interesting how it builds up, like introduces risk, then how to manage risk. Then the third one is how governance of risk management. So how does the board and the directors govern the risk management process. Then, following that, some models and methods are introduced. So there are credit risk transfer mechanisms. You understand what credit risks are, and the transfer mechanisms involve some derivative products. So before that, you need to see the intro to derivatives video for sure. Then the fifth and sixth one are very important models and theories that have been introduced for capital asset pricing. Second one is principles for effective data aggregations and risk reporting. So there are 14 principles, and this video I have not exactly taught anything in this video because it's pretty theoretical, but I'll be uploading a set of notes for this which summarizes this reading, and you should go through that reading and you need to almost memorize what the 14 principles are. Then there is enterprise risk management. So after you develop a framework, it should be enterprise wide. It can't be individual. Like a manager can't be managing his own risk or a single division, so to say. Then ninth one is learning from financial disasters. So we learn from financial disasters in the past. What we learned from the financial disasters in the past. The 10th one is anatomy of the great financial crisis, which is one of the most recent and very important crises. There have not been any major crises after that on a global scale. So let's hope they don't happen anytime soon either. And the last one is the Garp Code of Conduct, which has about five main principles on ethics. And ethical values are really important, especially in recent times, like I said, where people are very, very unethical. So the second book on quants introduces the fundamentals of probability. Then we move to random variables. Then common univariate random variables, it's not very difficult. It only if you've done stats, everything will be very easy for you. And even if you've not done, we'll make it easy for you. There's no need to worry about the terms that I mentioned, like Poisson distribution, normal distribution, binomial. And you should be very familiar if you completed a degree in economics or finance, or if you're working in finance. These are just basics of statistics, very basic. Like if you were to do a course on statistics, a degree in statistics, like I am doing, these are what we study in the first 3 to 6 months of our program. Linear regression, you might have done a small form of this in high school when you were back in high school, and it's very fundamental in the risk management process to have a regression system in place, because so that you can extrapolate from data in the past to the present. So in this one, the first one is very theoretical, banks, and it talks about the major risks faced by bank, the requirements for banks to maintain some buffer capital in case a crisis strikes, and it basically says what banks has to do for a bank has to do for risk management. The second one is about insurance companies and pension firms, and it basically tells us what insurance companies and again tells us what insurance companies and pension firms have to do with regard to risk, and it introduces some of the risks faced by them, and there are some calculations in this as well. The third one is fund management. So what is fund management? What is the system, and what do fund managers have to do to maintain their risk? Because usually in funds, which we call them hedge funds, they take a huge amount of risk. Mutual funds take very low risk because they are very regulated, because the common people's money is in there. But hedge funds have people investing in millions and billions. So government allows a free hand in that aspect, and they are expected to earn a high return. So they take very, very high risks, and a framework for that is also mentioned. The next one is an introduction to derivatives. So I'll be using parts of this reading in my introduction to derivatives video. The next one is exchanges and over-the-counter markets. So we usually trade on the exchange. That is, we have an exchange, we open an account, and we buy stocks or whatever we have to using that platform. But large firms, they enter into specialized contracts, let's say some special contract to suit their needs, which are not available on the exchange. So they find a counterparty to that and deal with them directly, without the presence of an exchange, but with the presence of a body, an over-the-counter supervisory body. There are a few of them. Sorry for that. Next one is central clearing. It's a continuation of the previous one. No need to worry. Then we move on to the different types of derivatives and what they are and how they are used. So futures is one of the first types of derivatives. Then we use futures, how we use futures for hedging, then foreign exchange and currency risk, because there's a huge currency risk involved. And we'll see everything in detail as we move forward. Options is very important. There are about one, two, three, four readings on options, and options are very important because the options market has seen a huge boom recently, with a lot of people entering into speculative trading in options, which I believe people who are not into who have not who do not have as much experience should not, because the leverage built into these products is insane, and people don't realize that sometimes. Yeah, let's see the last book now, Valuations and Risk Models. Again, it's taking a little long to load. Sorry for that. So the first one is Measure the Financial Risk, wherein we value at risk and expected shortfall are introduced and calculated. You'll see everything when you do the first book, and probably in the first few readings itself, you'll be introduced to all the terms, and later on we see what they are and how they are calculated and measure how useful they are, what are their advantages, disadvantages, everything. In the next reading, there are credit ratings. So what is credit rating? There are institutions which collect a lot of data on your firm, on your financial firm, and it release a rating for you that helps other your creditors judge your credit worthiness. That is, they will decide based on this rating if how much, let's say, interest to charge from you. For example, if you're very highly rated, this means the credit rating agency, which collects a massive amount of data, thinks that you're stable for now, but anything can happen. The credit rating agency does not assume usually does not assume responsibility. And credit rating agencies were in part responsible for the 2007-9 crisis, because they gave very high ratings. Let's say they gave A ratings to products that should have actually received C or D. I'm using A, C, D as an example, but this is not the actual nomenclature. I'll describe it when I come to this reading. Then we have country risk, credit risk, operational risk, different types of risk. So let's say here we talk about credit risk. That this is one reading. But when we move to FRM Part 2, there's a whole book on this. Again, operational risk, same thing. Then there is stress testing, which is very important. So what we do in stress testing is we take a model. So you have, let's say, 10 variables in your model. What happens if this variable is pushed to its extreme? How much losses will I face? And will I what will be the impact? Let's say we can do a reverse stress testing as well. That, let's imagine I failed, and in that scenario, what will be this variable? What extreme does this variable need to be pushed to that my firm fails? Then we have about pricing conventions, interest rate. These are basically related to fixed income from this part. And if you want, I'll make an introduction to fixed income video as well, if that will be required. But I think this will be very clear. Interest rate part, non-parallel interest rate. The last two are regarding options and the valuation of option prices, and these are again important. There are usually a few questions on the exam, and they take a little time to do. That is, they are a bit lengthy, these questions, but some theoretical questions are very easy and you can answer them within, let's say, 5 seconds. So it balances off. There is no need to worry overall. So this was the syllabus, and I'll be uploading a basic order of study, but that will not be absolute. You should absolutely see my first few videos, so to see the idea, to get an idea of how I'm teaching. Let's say you see the first video of each reading, each book, first few videos of each book, and you get a basic idea of what is my teaching style and is it suitable for you. And if not, if you require more in-depth teaching and more hours of requirement, then there are obviously other courses available that you can avail. And that's all for the syllabus for now.